Hi there, welcome to the weekly general update for the 28th and 29th of July. And we had two very spectacular uh, trading days on Thursday and Friday coming out of Europe and the US, and that has changed the short-term outlook quite considerably. And of course, as you may know, it all came out of a comment by Mario Draghi, who's the head of the ECB, and it was really a statement of the absolute obvious. It was like saying, yeah, the sky is blue. I mean, it's quite obvious, but his comments were timed and designed to move the markets. And I'm sure that a lot of the action that we saw on Thursday and Friday night was a fair bit about short covering, because there'd been an awful lot of people who were short the euro, US dollar, who were also short the European stock markets. And I believe his comments were designed to basically flush out those short sellers, seeing as though it also came at the same time as a short selling ban was imposed in Spain and Italy. So once again, the authorities have stepped in to mess up the normal market forces. Their impact will be short term, but as we've seen of late, it tends to be fairly significant, and so we need to take notice in the short term. So let's have a look at what the impact of all that has been. This is just a reminder on the general advice nature of this information. So a bit of a summary of the week. The S&P index ended up gaining 24 points, but there were two huge days to finish, and the S&P had been down quite sharply before that. So in actual fact, it traded over a range of 600 points, or about 600 points on the Dow Jones. So that's a very big range for the week. It's formed a new short-term high. We'll have a look at that chart in a moment, and that really does muck up the pattern, which looked to be unfolding fairly nicely. So 1390 is the line in the sand for me. If we start closing emphatically above 1390, then you've really got to stand back and say, look, the US market and overseas markets are probably continuing their rally off the October lows. So we'll just have to wait and see. But it basically touched that level on Friday night. So the next couple of days is quite important. It's all about the perceptions about Europe. Europe's a mess. The comments made on Thursday and the intended actions of the ECB don't actually change anything to my mind, but it's all about perceptions, and it's all about having flushed some short sellers out of the system. US corporate earnings are quite mixed, and they tend to be at the top of the cycle, so I can't see things getting a whole lot better from here. They're not particularly cheap. I'm not saying that the market's going to fall over, but it's hard to see the sort of fundamental situation that would drive a sustained rally. I think this rally, if we do get a continuation, is purely about central bank liquidity. That's all it is. It's not based on fundamentals. Now, if we look at our index on the week, we gained just 10 points, but we'll obviously have a pretty good day on Monday. And we're also near the top of a broadening range, which is capping out now at about 42.50. Now, the banks and the telcos are already fully valued in whichever way you want to look at it. So I don't see a lot of upside there on a sustainable basis. We might get a little bit of sentiment upside in the next couple of days, but it's hard to see them moving too much higher from the valuations that they're at the moment. And I'm still expecting that we'll see plenty of profit warnings as we approach profit reporting season in Australia. Now, the US dollar index is the currencies, as usual, that are really dictating play, and we'll start by looking at the euro. The US dollar has had a failed break of the trading range that it was in, broke north of it, and then has come back into it. And there was a really big reversal in the euro on those comments on Thursday. So I've got targets at 126, 127 and a bit, and around about 129 and a half. So we'll have a look at those charts in a minute. As a consequence, Spanish bond yields came down by almost 1%. down to 6.74, which is still high, but is obviously down below that critical 7% level. And Italian yields also fell below 6%. So let's have a look at some charts to start with, and we'll start with the euro. And you can see this is a weekly chart of the euro. There was a very clear downward trending channel. There was a target I had down here at about $1.18.5. But you can see equally we got a pretty significant reversal on Friday night. Now I would be very surprised because that has just completely swallowed up the two previous trading sessions. So I'd be surprised if there's not some more upside in the euro. Now I've got two Fibonacci scales on here. One of them, which I think is the more likely looking at the fundamentals, runs from the low of Friday night to the high of the 2nd of March. And that would see potential levels around 126, 127.7 and 129.4 as I indicated on the previous slide. So they're the initial levels to look at. However, if we got a more substantial move up in the euro and we started to retrace part of this whole move, which started on the 6th of May 2011, then we're looking at an initial level of around 131.6, and with the euro rising, and that will cause the US dollar to fall, and that's obviously going to be positive for stocks and positive for commodities. So I think it likely that we're going to head to at least 126 on the euro, and that should be positive for stocks and commodities for at least the next couple of days. Now whether it manages to push up to 129, if that's the case, then we might even see, after a bit more mucking around, we could even see the euro higher than that, which would be very positive for stocks for the second half of the year. So this level of the euro here around the 126 level, the euro US dollar, is obviously very important. Now it closed on Friday night at 123.2, so there's still a fair bit of upside in the euro US dollar, but that's the key that we're looking at the moment. Now if we look at the US dollar index, and this is about 55% of this index is basically the impact of the euro. You can see we had a clear trading channel. We've been looking at this now for months. We had a false break, as it turns out. It's come emphatically back into the trading range, and that generally means when you get a false break of a range and it comes back into the range, it will normally go all the way to the bottom of the range. Now that's not a guarantee, but that's what normally happens. So therefore, with more US dollar index downside, we really are looking at more upside in stocks. So that's why I think I think we're probably going to see at least a few more buoyant days. Now it does defy logic, but we've got to trade what we see and trade what is there, and that's what's happening at the moment. Now the impact of that on stocks was quite significant. This chart's a little bit messy, so let me just tidy this up a little bit. Okay, you can see here on the S&P we formed a low in June, and we've had this trend channel rising to the upside. We got a 2-day break of that trend channel. We had the market looking like it was running out of puff. You can see here each successive high was getting weaker and weaker. It wasn't making the other side of the trading range. Then when we got the break of this channel, it looked for all the world like we topped out and we're heading into our 5-wave decline, which would be the normal crowd behavior pattern. So everything had set up perfectly until Thursday. Comments from one person has basically scuttled those patterns completely. You can see we've had 2 huge days up in the US, and going back to those currency charts, looking at the likelihood of the US dollar heading lower at least for a few more days means that stocks are going to push higher. So I would think there's every chance that stocks will push higher in the next few days at least. Now my view still is that we will get some weakness. I think any old trigger will have us back into a weaker sentiment period, but just for the moment we need to be mindful of just how strong this rebound is, and it could very well, having basically we've now had a failed break to the downside of this trend channel, and we've now come back into the range very emphatically. So you'd have to say that a move to the other side of the trend channel is quite possible, and that would have the S&P up around about the 1420 to possibly even 1430 mark. So we certainly could challenge these highs from April of this year. So we're in for an interesting period over the next couple of weeks, but I think the key one to watch is that 126 level on the euro. Now, just for a little bit more evidence, this is the German DAX, which also two huge reversals in Europe on Thursday and Friday. So that's just supporting what's happening with the US market as well. Now, the impact on our market, this is the Australian ASX 200. You can see we've got this broadening wedge pattern that's formed here. We had a pretty strong day Friday. I would imagine we'll move up and be pushing above probably 42.50, 42.60 on Monday. So we may well see a break of that level on Monday, but it does depend a little bit on where we closed. Now let's have a look at gold. This is gold on a weekly chart. So we're in our 12th week now of this range between 1550 and 1650. So when you look at it on that view, you can see that over the last 10 to 12 weeks of consolidation, that basically the price of gold had dropped out of that range that or the trend line that we'd been following since October of 2008. So that was a significant move, but it's just consolidated sideways. We've got this downtrending line coming down through here, which at the moment is cutting through at around about 1670. So you'd say at the moment, looking at that we're still basically in a sideways pattern. However, when we go into a daily chart, it gets a little more interesting, because there's actually a shorter term triangle that's developed here, and the price is actually broken north of that, out of the apex of that triangle. So whilst the weekly chart is telling us that we still have a bit more work to do yet, probably another $50-60 to really signal a breakout, the daily chart is really saying that on a shorter term view that breakout has already occurred. Now if we have a look at the main gold indices, this is the Huey index, which is probably the most observed gold index, and you can see we've formed a new short-term high, so I would expect that it looks like we're probably pushing higher there. But the other one that I'm keen to look at is the gold ETF. This is the International Gold ETF. The code is GLD. Now you can see here that we've actually broken above, so pretty much the same as gold. We've broken above this trend line resistance just in the last few days. Now really what I'd like to see, to be absolutely definite about this, is a break of this little high here. So if we can form a new short-term high just above 159, so I'll close around 160 on the GLD ETF, would certainly demonstrate that that we've got some more strength in this market. But it's really the Huey index, so it's really the gold stocks, I guess, that is of interest for us, because most of us are trading gold stocks rather than physical gold, which is just so manipulated now. It's a bit of a waste of time, and we're almost there on the stocks. And we certainly saw a couple of positive moves on Friday in the Australian stocks. Now let's just have a look at at the last couple of slides. And the other comment that I want to make, of course, is that since 2008, when we really started with this massive central bank intervention, the impact of what they've been doing is getting less and less. The impact is less, and the time span that it has an impact for becomes less and less. So I would expect that there'll be a temporary impact from what was said, because frankly there was no action plan, there was nothing new announced. It was really just some motherhood statements made to basically frighten the market a little bit. So gold we've talked about, gained $43 on the week, and GLD breaking the trend line to the upside. Copper was steady at $3.42, so it didn't really respond very much to the lower US dollar, but it's still pretty buoyant. And oil was reasonably volatile during the week, but ended up settling around about the $90 for light sweet crude. This is the chart of copper. You can see over the last couple of weeks it's ticked up a little bit, but it's basically holding this range between around 330 and about 355. So overall, the most likely scenario is that in the very short term, I'm not sure. We had a beautiful crowd behavior pattern setting up. We'd started rolling over on the indices. Looked for all the world like we were heading into our 5-wave decline, and I believe we were. And now that central banks have stuck their nose in, and again they've kind of scuttled that pattern. So really, I think we've just got to step back for a couple of days and reassess. The 5-wave decline still possible, but really that case has been severely reduced, at least in the short term. So the situation that we've got in Australia is that the banks are fully valued, but they're in favour. So it's a bit hard to buy them because they're so fully valued, but everybody loves them. And we've got the resource stocks that are significantly undervalued, and on many metrics that you want to look at are really a strong buy. Particularly, I don't believe the global economic scene is anywhere near as bad as what is being factored in. And I don't believe the situation in China is anywhere near as bad as what's being factored in. But the result is that resource stocks are out of favour. So you don't really want to go piling into resource stocks with your ears pinned back either. So it's actually not a particularly easy time to trade confidently, because the stocks that are in favour are pretty fully valued, and the ones that are out of favour really fundamentally are quite attractive. So we've still just got to tread carefully for a bit, I believe. In terms of current exposure, if you've been trading with a fair amount of short exposure, I think you really need to take some profit and on those shorts and reassess. I'm still of the view that we'll see a sell-off in the next few months. There are just too many potential negative triggers in Europe for that not to be the case. But we could see markets punch higher for a few more weeks here. And and then following that sell-off, which I think we'll see some sort of sell-off through August and September, I would then expect to see some strong gains into the year end, because central banks are just completely addicted to quantitative easing, and you can almost bet your life on the fact that there'll be some major stimulus from both the European and American central banks, and also from China as well. So that's it for this week. There was a lot to cover, but look, really everything hinges around the direction of the euro US dollar in the short term, so that's the one to watch. That's it for this week. Cheers.